to influence the acreage mix. The U.S. wheat carryout is going to be abundant. Global stocks are going to increase. I just don't think we have a storyline there. Looking ahead to possible factors on the horizon, if you notice here, if you glance on the sheet, I've got many things listed, not everything, and in fact most things are not involved with the supply and demand balance sheet of corn and soybeans. At the top of that list, I rank the interest rate outlook. I think that everyone would agree that there is no doubt interest rates are going to go up, monetary policy is going to change. The question is all about timing. And we don't know, but if you listen to the Fed comments, these guys are out on the circuit speaking all the time. If you listen to what they're saying, if you attempt to discern what they're saying in between the lines, there's a lot of pressure to begin moving on a change in monetary policy. And whether that is going to first be seen as an interest rate hike or whether it's going to be first seen as a change in language, I'm not sure, but I wouldn't be surprised in April already we see changing language from the Fed, and the trade, the investment community, the spec community begins to prepare and anticipate a change in monetary policy. The impact on corn and soybean prices, logic would say shouldn't be significant, but the fact that money flow is such a big deal to the markets, it is an important thing. While we have bullish fundamental foundation, it remains money flow that determines the scope of the price moves. Realize that yesterday's acreage mix didn't provide any major surprises, and the trade has been fully embracing a bullish outlook for some time. Yet corn experienced a 75-cent break and then a $1.30 break in less than a 30-day window during the February and March period. This occurred despite universally bullish trader sentiment and complete expectations of supportive March 31st reports. And despite the bullish shocker of yesterday's data and euphoric trader reactions, old crop corn is at the same price level that was first traded near the middle of February. Soon the planting decisions will be finalized. There'll be no need for the carrot at the end of the stick to persuade U.S. producers to increase corn acreage. Decisions will have already been made. Thus, if investor sentiment is negatively influenced by monetary expectations and shifting investment focus, we won't have the energy needed to push values to another leg higher. And I think you also got to throw in a combination of what the spring weather is going to be like, but just at stopping right there with the interest rate outlook and its ability to shift investor focus and what shifting investor focus means towards money flow into the commodity market, it's equally important to yesterday's reports, and I would argue that it may be more important because yesterday's reports still are a moving target. The spring-summer weather, who knows what the future holds there. However, we must recognize that the market will very quickly add the what-if premium to prices. If this occurs and prices still struggle to build any meaningful strength beyond that February-March price peaks, then the price ceiling theory that I've talked about for several weeks is strengthened, and the next step in that cyclical process will be a liquidation pressure. Consequently, if weather turns out to be favorable or acceptable and the post-report buyers will be disappointed with stalling price action after paying 70 cents off the last little low to own corn, and weather happens to be favorable, here again we run the risk of liquidation pressures even before we get into a potential threat of summer weather activity. While trader sentiment will universally be bullish and completely unwilling to trade corn and soybeans from the short side probably through August, that doesn't mean that we won't experience price declines that could easily be quite significant under liquidation pressures. I think it would be wise to view weather from the perspective of two completely different windows. First, you have the planning early development window, and then you got the mid-June through mid-July window. After this current price surge, a liquidation event is the most likely thing that one would expect to occur before a summer weather story develops, if one develops, and if we have some sort of favorable or accepted spring weather conditions. As far as demand rationing is concerned, here too we have a very elusive moving target that is difficult to define until after the fact, maybe well after the fact. Yet it might be wise to remember that we may have a very tight balance sheet, but we may not need to actually ration that much demand. It is one thing for a market to adapt to tight stocks versus a market that must actually reduce demand by a significant amount to just get to the point of having tight stocks, such as happened in 1996. There we had to ration several hundred million bushels of corn demand in order to get to the point where we had enough to be in the tight stocks mode. We don't have to do that this year. At least we don't think we have to do that until or unless we get a summer weather problem. As far as government policy changes, I think that the congressional world is completely different after the 2010 elections. The mood is quick to cut spending. The mood is quick to find programs to end. This is not the type of environment that will seek to extend or expand biofuel tax credits or tariff protections. So I think we have to constantly remember that the ability for the government to make changes certainly could exist, and the odds of them making changes that add money to the ag sector are slim. There's a much better chance that they're going to make policy decisions that take money away from the ag sector. I think the U.S. farmer profit margin squeeze, if there's one theme I would like to put out there today more than anything else, this is probably it. At some point, the right combination of high prices, acreage expansion, favorable weather, and demand contraction will lead to building U.S. and global supplies. It is not a question of if, it's just a question of when. Anyone with an accurate memory will tell you that these transitions lead to profit margin squeeze on producers. Inflated input costs are always slower to decline than the price offered for the commodities, which of course leads to the profit margin squeeze. There is nothing that a producer can do to protect this risk other than to continue extending his price coverage protection. You won't always be able to wait for the crop insurance rates in February because it may be too late. You won't always be able to expect the market to save you when you miss a selling opportunity. The tables will turn on the user and the producer. They've always done that. It will always happen in the future. It's just a matter of when. When you can take advantage of historically large profit margins, do so. Maybe you're not comfortable doing it on all your bushels or even a large percentage, but to not do it on some, I think, would be a mistake. It really wouldn't be that difficult to imagine the right set of circumstances that could quickly lead to profit problems for those who choose, not to make sales. The new crop corn marketing approach choices, as always, the question is relatively simple. It's not easy, but it's simple. Are you going to make sales now, or are you going to avoid sales now? That's basically the choice that you are facing. I think that I could probably end this slide with just making the comment, focus on profit offered. In many respects, I think that's enough said. However, that's not a very popular way to look at things, and it's also very difficult when you're a producer and you make that sale and it's the last time you get to market that one bushel, that single bushel of corn or beans. It's difficult to let that go. I understand that. We also have the last year where forward sales looked great for much of the marketing year, but all of a sudden things changed as we got closer to harvest, and now what at one time was considered a good sale now is reflected back upon as being a poor sale. That weighs on everybody's decisions, and we're always greatly influenced by the previous year's market cycles and marketing approach and how it worked out. You need to evaluate your crop insurance protection. If you don't have crop insurance, you're like a skydiver that's been blindfolded and told that he may have he's got to get on the plane and he may have a parachute strapped to his back, or it could be just a school backpack. However, since he's been told that while he's boarding the plane and he will be in flight, we don't know yet whether he will be asked to jump out of the plane. The crop insurance offers some level of downside risk protection. No crop insurance means your only downside price protection will be when you establish a sale or a hedge. Every time prices make a downturn, you must decide whether you have to make a sale to protect profits because you may only have a school backpack, or you must decide that the market will come back and save you because you actually have that parachute strapped on your back. If prices turn lower and you elect not to make a sale, what happens if the market doesn't give you that infamous, one more chance? you may find yourself in a free fall with just a school backpack that is loaded with textbooks and no parachute and no time to read the textbooks. So crop insurance is always a significant part of it, and how you market from here forward is greatly influenced by whether or not you chose to take out crop insurance. It's important that you recognize and respect the ability of the market to achieve a factored-in status. I don't think to anybody that's watched markets for any length of time, that's not a surprise. We all see times where the market gets ahead of itself and has already factored in what becomes fact, and by the time it is a known fact, it then the old saying, buy the rumor, sell the fact. So we've all seen that. We all know what that means. I think it's important that we, looking forward to marketing choices, you equally respect potential for favorable yields as opposed to distress yields. Why is it that we all recognize trendline yields make a steady upward progression, and this couldn't be accomplished if the majority of the time yields were distressed? But constantly, why is everyone so much focused on that possibility of distressed yields as opposed to the more likely, historically likely, favorable and acceptable yield scenario? History clearly argues that odds favorable, acceptable national conditions. And other than crop insurance, how do you define downside price risk? I'll show you some charts here in a second that reminds us that when things turn, we always underestimate what that downside risk really is. If you want to take the approach that you avoid sales now, a lot of that's going to depend on what percentage have you already sold. What is more important to you, missing that future potential profit that might loom on the horizon, or whether you're more worried about losing the profits that are currently offered. Only you can answer that question. Certainly there's some merit in the discussion. It depends on how well you're able to handle risk, but I'm not sure that's a good question. If you can handle the risk, why do you want it? If you can't handle the risk, you certainly don't want to take it. I think it's important that we seek proper perspective. Nobody is going to sell the top tick, and if you do, you won't sell it on all your bushels. And I think if you, probably the most important thing here is, are you going to be able to sell on weakness? Because if you're not willing to sell now on strength, then at some point in time, you're probably going to be forced to sell on weakness. Will you be able to sell on weakness? And remember, to sell on weakness requires you to completely shift gears and say your old attitude that passed up price X was wrong, and now you're willing to sell at a price lower than what you just turned down as being enough. That is a very difficult thing to do mentally. It's very difficult to make that type of transition, and it's very difficult to recognize a major turn versus just a minor setback. Again, I think the most important thing here is to focus on profit.